Some possess it. Some lack it. Some have mastered it, while most are still in pursuit. You might consider money merely numbers, spreadsheets, and math, an equation to solve. Yet, real financial decisions are made far from calculators, around dinner tables, influenced by ego, pride, fear, and personal history. The essence of money lies in the interplay between the cold arithmetic of a spreadsheet and human nature. When it comes to money, we are complex beings. Financial success hinges more on behavior than knowledge. This video draws inspiration from Morgan Housel's insightful book, The Psychology of Money. Let's explore the fascinating, human side of money. Financial DNA. We come from different generations, with parents earning various incomes, holding different values, and living in diverse parts of the world. Our unique economic environments, incentives, and opportunities shape our experiences with money. Take the stock market and inflation as examples. People born in 1970 saw the S&P 500 almost tenfold during their teens and 20s, fostering a positive view of the stock market and a propensity to invest. Conversely, those born in 1950 saw a stagnant stock market during their formative years, leading to a negative view and reluctance to invest. Those born in the 1960s faced significant inflation in their teens and 20s, making them more aware and wary of its effects. In contrast, people born in 1990 experienced relatively low inflation, leading to less concern and awareness. A person's experience with the stock market and inflation during their formative years heavily influences their attitudes and behaviors toward investing and financial decision-making. People justify their financial decisions based on the information they have and their mental model of the world, shaped by their parents and unique life experiences. Although they might be misinformed, lack information, or make poor decisions, their actions make sense to them at the moment and align with their personal story. Housel notes, people do some crazy things with money. But no one is crazy. We all have unique worldviews, and since there is no universally correct way to manage money, none of us are crazy. Compound kings. Warren Buffett is often hailed as one of the greatest investors ever. Remarkably, $81.5 billion of his $84.5 billion net worth was earned after he reached his mid-60s. Housel explains that Buffett's fortune isn't just due to being a good investor, but to being a good investor since childhood. Starting serious investing at age 10, Buffett harnessed the power of compounding. Consider investing $1,000 at an 8% interest rate. After 1 year, you'd earn $80. Compounding the total $1,080 at 8% the next year would yield $86.40. This process of earning on the initial investment and the interest continues, showing the power of compounding over time. Buffett began investing seriously at 10 and had a net worth of $1 million by 30. If he had instead spent his early income on travel and luxury cars, starting with $25,000 at age 30 and retiring at 60, even with his impressive 22% annual returns, his net worth today would be around $11.9 million, 99.9% less than his actual net worth. Buffett's financial success stems from his early financial base and longevity in investing. His skill is investing, but his secret to success is time and the power of compounding. To put this into perspective, Jim Simons, a hedge fund manager, has compounded money at 66% annually since 1988, a much higher rate than Buffett. Yet, Simons' net worth is $21 billion, 75% less than Buffett's. The reason is that Simons didn't start investing until he was 50, giving him less time to compound compared to Buffett. Housel estimates that if Simons had Buffett's timeframe, his net worth could be 63 quintillion 900 quadrillion 781 trillion 780 billion $748,160,000. The power of compounding is undeniable. Despite its counterintuitive nature, it should never be underestimated. Pessimism and money. Optimism is believing in favorable outcomes over time, despite setbacks. Yet, when it comes to money, we tend to embrace pessimism. Historically, things have generally improved, so why do we favor pessimism? Because good things take time and don't happen overnight. Money matters to all of us, and bad economic news grabs our attention more. A 40% stock market decline over 6 months is alarming, whereas a 140% gain over 6 years might go unnoticed. Slow progress, such as medical advancements saving 500,000 American lives annually over the past 50 years, attracts less attention than sudden losses like terrorism or natural disasters. Overnight tragedies are common, overnight miracles are rare. Despite setbacks, we can be optimistic, believing in positive long-term outcomes. When the news highlights economic woes or market crashes, remember that things generally improve over time. 2 forgotten elements. In 1968, of 300 million high school-age people worldwide, 300 attended Lakeside, a small school in Seattle with a professor who leased a teletype Model 30 computer. This rare opportunity profoundly impacted one student, Bill Gates. From 300 million to 300, Gates had a 1 in a million competitive advantage. Along with his exceptional intelligence and vision, this head start was crucial. Gates acknowledges this, stating, "If there had been no Lakeside, there would have been no Microsoft." However, a third member of this high school prodigy group was Kent Evans, who, just as intelligent and visionary, tragically died in a mountaineering accident before graduating. The odds of such an accident are around 1 in a million. Gates and Allen's rare success was matched by Evans' rare encounter with risk. Luck and risk, like wind and waves, shape our lives. Success is a mix of talent and luck, and understanding this helps us approach financial decisions with humility and perspective. The key to happiness. People seek wealth for happiness, but Housel asserts, the key to happiness is the ability to do what you want, when you want, with who you want, for as long as you want. The pursuit of material wealth often leads to working harder and losing control over time, despite greater riches. Studies show that having control over your life predicts well-being more reliably than salary, house size, or career prestige. Ultimately, controlling your time is the highest dividend money pays. Pursuing money without valuing time is like filling a bucket with a hole, it will always leak. True happiness comes from controlling your time and enjoying the fruits of your labor. Tail events. Heinz Berggruen fled Nazi Germany to become a successful art dealer, collecting works by Picasso, Klee, and Matisse. In 2000, he sold part of his collection for over 100 million euros. His secret? Skill and luck. Research firm Horizon explains that great investors buy vast quantities of art, hold on to them, and wait for a few to gain significant value. Most of Berggruen's collection was of little value, but a few masterpieces made his fortune. This concept of long tails, where a small number of events account for the majority of outcomes, applies to investing. Venture capital is a prime example. Most startups in a VC fund fail, but a few outliers make substantial returns. Amazon, for instance, drove 6% of the S&P 500's return in 2018, largely due to Amazon Prime and Amazon Web Services. Despite failed experiments like the Fire Phone, Bezos embraces failure, stating, "If you think that's a big failure, we're working on much bigger failures right now." Tail events drive success, and recognizing this can help us accept failures along the way. True wealth versus being rich. Understanding the difference between being rich and wealthy is crucial. Richness is about current income and possessions, wealth is about unspent financial assets. True wealth is unseen. A person driving a Lamborghini might appear wealthy, but appearances can be deceiving. Many live beyond their means, relying on debt for their lavish lifestyles. Wealth is about financial assets you haven't spent. Accumulating wealth requires self-control and restraint, turning down luxuries to build your future. The real price. Imagine climbing a mountain to reach the peak and enjoy the view. Along the way, you might face rain, get lost, or injure yourself. The difficulty isn't always clear from the ground. Investing in the stock market is similar. Many think they can avoid risk and get something for nothing. Housel compares the stock market to buying a car. You can buy a new car, high reward, high price, a used car, lower reward, lower price, or steal a car, trying to get something for nothing. In investing, people often try to steal from the market, avoiding volatility and risk. To earn an 11% annual return over 30 years, you must accept market volatility. Successful investing requires paying the price, not just in dollars, but in accepting the emotions that come with risk. Recognizing this price is crucial. Convince yourself it's worth paying, like an admission fee, and you'll enjoy the experience. Hedonic treadmills, enough. Know when enough is enough. The hedonic treadmill concept means constantly moving the goalpost. Bernie Madoff and Gupta, despite being ultra-wealthy, resorted to crime for more money, never finding enough. The endless pursuit of wealth without recognizing enough leads to a lack of happiness and fulfillment.